Thank you, Marty, for this great opportunity again to be here. It's great to be in New York. Always fun to come to this city and spend a couple days. Marty's assembled a great team of people to talk about manager selection with me today. To my left, we have Howard Geller, consultant for Hudson Peak Group. To my far left is Chip Perkins, who you probably have seen here before, Perkins Fund Marketing and managing member of that group. And to my right is John Service, Director of Capital Introduction for Cowen. So we're going to be talking about a bunch of things. We're going to be talking about investors' appetites, perspectives of the domestic and international investors, relationships between investors, managers, ESG and fiduciary rule, emerging managers, the role and value of placement agents, very near and dear to a couple of people on this panel, and finders, due diligence, and among other things. My name is Mark Heil. I'm with Pacific Premier Trust. We are in the self-directed IRA business. We help people invest into alternatives using their retirement funds, and there are a lot of tax benefits in doing so. I'm part of the institutional team, so I work specifically with asset managers, RIAs, and broker dealers in terms of what they're trying to execute and do, and facilitating that and making their lives easier. But when you're part of a trust company and you're part of a bank, we have a lot of lawyers and a big compliance department. And Chip's favorite part here is you can see him already going, oh no, not again. I'm required to read a disclosure. It applies to everybody for the 2 dates, okay? So we do it once, get it over for everybody. Information presented is for educational purposes only and is not intended as and may not be relied upon as tax, legal, investment, or other advice. Pacific Premier Trust performs the duties of a custodian, and as such, we do not evaluate, recommend, or endorse any particular investment opportunities. You're advised to consult your professional advisors for specific guidance regarding your investments. Investments are not FDIC insured and subject to risk, including loss of principal. One little extra thing I always like to toss in here, to the extent I express any opinions, they are my opinion, not that of Pacific Premier Trust. I'm not speaking for them. For the next 50 minutes or so, this panel and I are going to have a conversation up right here. This is not going to be, I ask a question and Chip answers and Howard answers and that. It's going to be more of a discussion. I invite you to join in. I just ask you to be brief if you have a comment or a question. We love comments and questions. We don't love speeches. So if we could keep it to the point, that would be wonderful. So I've already given them a very high level introduction of the group. What I'm going to do is, and this will go down the line, we'll start out here with Chip and have everybody introduce themselves. And just one thing for Marty though, and that is, over the summer, what did you play most of? Pickleball, tennis, or golf?
About equal.
About equal.
What are you having more fun at? Not golf.
Give us a little background here.
Chip Perkins. My firm is Perkins Fund Marketing. We are a 25-year-old placement agency. We've raised about $7 billion in the alternative area. All sorts of strategies. We're a registered broker dealer overseen by FINRA and the SEC. Everybody on my team is registered and can sell legally. That's about what we do. We just do it every day.
You've done it for a long time.
Long time.
And how much you raised collectively, roughly?
About $7 billion.
About $7 billion. Howard?
I'm an independent consultant for family offices, RIAs, high net worth individuals, others in the ecosystem. And my background is in the institutional investment management business, everything from marketing, client service, portfolio analytics, and just putting out forest fires within an organization. And right now, what I do is for family offices and RIAs, I basically focus on investment manager due diligence, ongoing performance and attribution and asset allocation, finding portfolio accounting and reporting systems that they can use, best practices, solve problems, find ways for people to talk to each other instead of at each other.
So tell me, you've been a consultant now since what, 2009?
Yep.
What's been the strangest assignment you've got?
I think probably trying to mediate between siblings over really small issues that just ballooned into really, really big issues. Just trying to get people to talk to each other and just not understanding, the difference between A and B. That's probably been the strangest because it delved into, a lot of personal stuff that I wanted no part of.
Fair enough. And it's not an uncommon story
No.
within the family office business.
It's way too common.
John, you want to tell us a little bit about yourself and Cowan, what you do for them?
Right, so at Cowan, I'm a senior member of the CAP Intro team and cross over a couple different verticals. Not only do I work on traditional finance, but I also work on Cowan Digital. So Cowan has rolled out a digital arm, and it's becoming a bigger focus pretty much every month that goes by. So you can think of that as being just as Cowan traditional, which is prime broker, outsourced trading, electronic trading, custody. You can also think of Cowan Digital as the same thing, just doing it on the digital side. So institutional quality manager with your risk management. Outside of that, historically, prior to joining Cowan, I was worked at a marketing firm that also did outsourced CAP Intro. So kind of porting that over to Cowan at this point in time. And then prior to that, I was in the family office world as an allocator. And as well, I worked at a fund of funds, and I was also in the capital markets working on alternatives.
So you've been in this business of raising capital, listening to people's pitches, both sides of the table.
Yes, and it's interesting. Everybody thinks they're unique as a fund, and what I would say is, from an allocator perspective, you've heard the pitch 100, maybe 1,000 times, depending on your age and how long you've been out there. It's always interesting when you find someone who's truly unique and has really differentiating factors. So just to all the funds out there, I would just say, you know what, try and position yourself as having certain attributes that really differentiate yourself. Because when that comes across, you're going to get an allocation.
Just curious, out of those thousands of funds that you've met, any of them ever been second quartile?
No. No.
Chip,
You mean the ones I've worked with, or the ones that said no to?
Just if you met any, I've been very curious. Chip, yesterday on our prep call, and it sort of ties into John's comments just a second ago. You're always hearing from LPs they want something different, something that generates high alpha and it's non-correlated. And I'm wondering if you could tell us what that is and what the challenges are for those managers when you do find them.
We left that without risk.
Oh, without risk.
High
I'm
alpha,
sorry.
no risk. Guaranteed return.
Liquid.
Liquid.
I'm not allowed to use that language. Where's Peter? Is he
Um,
around?
Your lawyer's not here. What is that? Today, finding alpha generators is more difficult than it's been in the past. John pointed out yesterday when we were talking about, what's going on in long short equity, because out of the gazillion hedge funds out there, about 72% of them are probably long short equity. And a lot of people say, oh, I don't want long short equity right now, or I have long short equity, I don't want any more. But what there aren't a lot of, and John pointed this out, not me, is market neutral funds, which are not without risk, but maybe a little less risky in this environment. So there is interest in that right now, for sure. But if you're a long biased manager right now in the group that we, focus on, which is people that want to buy alternatives, you're not very interested unless somehow as a long biased guy, you're up 40%, which is kind of tough this year.
John, anything to add?
Yeah,
or-
just roll on to Chip's comments as to what we're seeing out there, what's of interest strategy wise. And I'm not sure if that was one of your asks out here, but
Please.
we'll roll into that. And I'm sure Chip's seeing this as well, and Howard. But we're seeing a lot of asks for macro funds, commodity funds, as Chip mentioned, market neutral, but as well rolling that kind of into a bigger ball. I would say low net, right? So sub 20, maybe sub 10. Those are big asks out there right now. On the flip side of that, what we're also seeing is those players who have long only portfolios. There's asks out there because what they've done is gone back and reassessed what they've seen happen over the last, call it 18 months with their managers. And there's a number of redemptions out there. I can say for sure, some out for September, some out for December, and they'll be looking to reallocate those assets.
So you're expecting a strong end of the year, or what are your thoughts there?
For managers?
Yeah,
Oh.
or for managers getting re-ups or
Yeah,
investments?
so I would say that that's probably going to be stronger. A lot of work's going on now. I'd say that's going to be stronger in the first half of the next year or first
Okay.
quarter. Yeah.
So not necessarily 12/31 this year. It's going
No.
to go into 2023
Yep.
for that.
It's never 12/31 because they got to get the money back first.
It takes a couple of months.
In this area of new and funds and assets and finding managers, let's talk about digital for a minute or two. It's sort of your area here. In recent years, we've seen a lot of interest in coin-based funds, but there seems to be a shift. And I think, Pat hit on some of that with the DeFi and things of that nature. So where are the hot spots right now in the digital? What are people looking at, and what's really getting people's attention?
Right. So I would say, well, you can bifurcate it, right? So you have the VC allocation out there, and so obviously longer duration. You are buying coins. Sometimes you're buying equity, but those things haven't been released yet, and so you're seeing a lot of Web3 out there. I would say that you're seeing a lot of NFT continued out there, and then also in the gaming industry. But I would say the focus is more on the rails and the picks and shovels than on top level, say, games, things like that. And so that's very big out there right now. I would also say that what's also exhibited itself is just like in the hedge fund world, trading strategies. As the market has developed in crypto, it's availed itself to a variety of different trading strategies, right? So you've got yield farming, you've got some market neutral trading, long short managers, you've got systematic managers out there, high quant with machine learning. And so in that bucket, we're seeing a lot of ask out there for that. In the DeFi area, there are risks that go along with the DeFi and the trading around that, the yield farming that goes around that. So institutional investors, so I wouldn't say family offices are more receptive to it. Other institutional investors, whether it's foundations, endowments, pensions, have a little bit less risk tolerance, and so they haven't adopted that. Where we are seeing adoption is with groups that are more institutionalized, have the ability for capacity, and then along with that are choosing partners that make them institutional.
Gotcha.
So hopefully that did.
Yeah, that was a pretty good summary. I rather enjoyed it and got a lot out of it, but I did want to just shift and get Howard into the conversation a little bit. And, we heard the talk by with Belkin report earlier on the economy. And obviously things have changed from low volatility, steady growth, and low inflation that we've had for about 10 years or so, with rising interest rates, the pandemic, change of administrations, upcoming elections, inflation, so on down the line. And, Marty pointed out that, he doesn't think things will ever get as dire as the 1930s, but put out there, there are some unknowns with the current world situation, right? We don't know, what's the food's going to be like over the winter, particularly in the next year. Some shortages being predicted in that area, where we're seeing obviously Europe being cut off from Russia in terms of oil. Now already there was a movement towards, getting coal and stuff over there, but that's going to have a huge impact on the price of oils and things like that. Your commodities, areas, again, going to be something driving that. So my question for you, with that long lead in, Howard, after talking about not giving speeches.
It's just an intro.
It's just an intro. Is how does this affect the mindset of the investor, the family office, the institutional investor? How does this impact them? The endowment, give us your thoughts here.
Just for the institutional investor and the endowment, they have a longer term plan. They have actuarial assumptions that they work by, and they work by committee. And for the family offices, I work primarily with smaller and mid-sized ones, maybe one wealth owner, a couple wealth owners that drive the whole process. And I'd say they get more nervous more quickly. And, I'll just go back to when technology really took hold in the equity markets. It was like sell first, ask questions later. I think a lot of family offices in that boat are doing a lot of the same thing. Something that they're nervous about, get out of it right away. In particular, publicly traded debt and equity. Get out right away. We can always come back later. The cost of trading is much less than it used to be. It's easier to do. So it's like, all right, let's regroup rather than take a 20 or 30% hit, and let's see what we do. And then I find that they're much slower to get back into the market. Even when the market was going up, they'd still be a bit nervous about moving back in. It may not be into the same thing. They maybe look for, well, let me find another asset class, another sector that looks less risky than what I just sold out of.
Now, your client base that you're working with right now, what are the specific questions they're asking, or things that they're wanting to know about, or want your opinion on?
Market going to go down? When is it going back up? It's the simple, basic question. When is it going back up? And what do I do? Like, you have to have a plan. There's one family office that I do some work for. One wealth owner, billion plus, always thinks there's another pot of gold at the end of his rainbow, and he just wings it. No plan. It makes no sense. Everybody who comes in contact with him, his general counsel, his accountants, say, you can't do this. He does it.
He has the billion.
He's got the billions. His it's his game. And there are others who are smaller and just much more conservative about how they invest. They have a core investment that and they have a rainy day fund, in case, we hit down 20, 30%, there's something there that's liquid, that's safe, that, will, carry us through until, the world turns around.
Chip, why don't you, follow that up a little bit and talk about your experiences and what you're hearing, and particularly how does it impact their manager selection?
Well, manager selection is done on a lot of the things we've talked about already. Liquidity is important, alpha generation, non-correlation, and strategies that people want. We always put out emails to a group of our potential clients when we're thinking about certain strategies, and ask them, would you be interested in agriculture? Would you be interested in a non-correlated municipal bond portfolio? Would you be interested in a market neutral long short, a macro? Get feedback from them first of all, because we're the only people, and I've done this before. 14 years ago, I picked up convert our manager, and I thought it was time to get back into it. My team didn't think so. My clients didn't think so. So that was a fail. So we just, are now trying to incorporate everybody. In my particular case, my salespeople, all have a vote when we decide we're going to do or not. And if one or two of them say no, we just say no and don't go forward. But in the environment we're in right now, most of the people we're dealing with do have a plan, and they have a longer term view because they're already rich, and they're just trying to hang on to it, not necessarily get the next pot of gold. So our calls are pretty simple. Is this something that you're interested in today, tomorrow, 90 days, 6 months, or never?
Do they ever say, hey, I'm looking for this?
Oh, yeah.
And recently, what's this? It's everybody's thought out here.
Liquidity, alpha,
Okay.
no risk. That's everybody's. But we're finding more of is unique strategies. I happen to have a unique strategy, which is an electricity trading,
Electricity trading.
which is unique. Not a lot of people do it. He's up 5% on the year, so that makes him special. But he can only take 150, $200 million. So I can't go to pension funds. I can't go to billion-dollar guys necessarily, because then we get overweighted in one or two people in the fund. We all know that if one or two people are in the fund and they're the majority of the assets, if they all of a sudden don't like it, everybody's going to leave. They're gonna go, what did I miss? Why'd they go? So, what are the strategies? They range. You got to find somebody who is unique, and different, doing something that you're not. Because if you try and tell me that people don't have long short equity in the portfolio, you're wrong.
John, how about yourself? What are you hearing?
Yeah, so with regards to niche opportunity sets, I think that it's always for family offices, it's always in vogue. They're looking for areas that they can extract alpha from that are less capped than everything else that's picked over. Some are more sophisticated than others. Those that are more sophisticated tend to gravitate towards that. And it also depends on the AUM that they're managing to, right? So sometimes it's not cost effective for them to go into the more niche opportunity sets because they just can't allocate a small sum of capital. It happens. It is what it is. But outside of and those are broad based. There's a number of them out there. You just have to hunt and peck around, and you need people like Chip to find them as well. I think from the Callan Cap intro side, we view ourselves as just being an extension for those allocators. Okay, you tell us what you're looking for, to the degree that we have it, or that we are talking to somebody who does have something like that, we can make that introduction for you, and that's what we consider our value add, right? We're somewhat indifferent, right? But we're looking to team with those allocators to help them in their sourcing needs. And then outside of that, as I had mentioned before, right, in vogue are those commodity guys and unique commodity traders. And if they can be more on the market neutral side, all the better, right? And generate serious alpha off of that by extracting from the volatility that's present within those commodity markets. And again, it's been volatile of late, so low net, market neutral in the equity space has been great, right? And so hopefully that'll continue.
So you got a client. It's a market neutral fund, something everybody wants, likes, got good returns, good manager, good story. Are the hoops higher today for them to get an allocation? Obviously, there's limited dollars out there.
Yeah, absolutely, much higher today.
There's a lot of money out there. There's a lot of money out there. It just doesn't know where it wants to go.
Yeah,
Good point.
And the allocations are few and far between.
So how does that change the sales cycle then? I mean,
Made it even longer.
but I mean, from your perspective, okay, the old expression, you're putting lipstick on the pig, right?
No pigs.
No pigs.
My portfolio.
But how are you making your what's the conversation like today with them to get them to say, okay, I'm willing to put some money there?
Well, first is, first thing we always open with is, what are you looking for? What do you guys want to allocate? Do you think you want to? And then we think about what we have in our portfolio and we see if there's some kind of fit. And then we, just begin the process, which has now gone from, in the last 25 years, from 3 weeks to 2.5 years to get some people in. I mean, we had a win yesterday, but it was a guy that we've been talking to for 2 years about a single stock portfolio. 2 years, but he's written a $25 million check. It was not bad. He's got plenty more. But, people now are just hesitant. If you look back over the last couple of decades, it was 1 in 20 when we got into this. Then it's 2 in 20. If you're Stevie Cohen, it's 20 and 20 or whatever, you can charge. People are upset and ticked off about the fees, ticked off about not getting hurdles. They're ticked off about performance. They want liquidity. They don't want to have somebody all of a sudden just close up and say, sorry, I'm just not going to do this anymore. So there's a lot of challenges in talking to clients about what it is that they want, what kind of manager, what kind of service providers they require a manager to have. So it's just more challenging.
Howard, you want to tack on here and just talk a little?
Sure. What I've found, people want managers who've been successful before. They don't always like to do the startup. They want to see that there's a good track record. They don't like people who start one up, shut it down, and then come back another day and say, hey, I'm going to do the same thing again. Let's start fresh, just because they took a market hit. But they like to see people who are a consistent, repeatable process, not just winging it. Like if you're a quant, people don't want to see, nobody ever has a bad back-tested model that just doesn't exist in the real world. It might, but people need to see that there's success there. And a lot of people like to jump on it a little too late. That becomes a problem. You think you're smarter than the average bear. You did your due diligence and you think you're in there in the beginning, but you have to see how the track record was built. Was it built on a small asset base or a significant asset base? And can the manager move the assets around? And that's it's an important question, and I don't think a lot of people ask it. But from my experience with some of the family offices I'm working with now, they're not the most sophisticated, and they don't ask those questions. They're either new to the business, or their expertise is from another field, not necessarily investment management. Real estate is different than traditionally traded publicly, debt and equity. Sold the family chemical business, like you get the chemical business, but you don't understand necessarily how private equity works. So everybody's looking for something different, but the key themes that I see are consistent, repeatable process and a record of success, not necessarily with the fund you may have just started, but with previous things you've done.
So, John, what I think I'm hearing from Chip and Howard, excuse me, there, is they tend to become more conservative during times of instability. They want proven assets, proven asset managers, people who work together for a while, things along those lines. So what are the incentives or are there incentives? Do incentives ever work in the business? That's always a question I have, that managers are offering today to once when they've got somebody's ear and they like the strategy, to get them across that barrier.
Right.
to put the dollar in, particularly if they're an early and one of the first investors into the fund.
Sure. There's, so generally speaking today, it's very standard to have a founders class. I don't think I'm telling anybody something that they don't know, but, and that'll come with, either a slightly longer lockup period, and lower fees. We're seeing 1 in 10, as a general fee structure. Depends on how net long you are. If you're fairly net long, you might have a hurdle rate in there. If you're not, then it's, just a flat fee structure. It might be a 2-year lock. But those are things that, that funds are viewing, that we're seeing out there. And quite often, and also Cowan actually sees a lot of earlier stage funds. So we help coach the funds as to what is market appropriate, what could attract you assets, how to get those early assets. And anyway, yeah, so those are some of the mechanisms that we're seeing out there. Obviously, for really early money, seed money, things like that, you're going to give up economics. A lot of what we see is not wanting to be from the seed or not wanting to be a GP, but giving up a rev share. And so that's very happens quite often. So I would just encapsulate it to say that's what we're seeing out there for those early stage investors.
Chip, anything to add on there?
Yeah, I think that no matter what the family office is doing or how they made their money, there is a risk bucket that people are tending to get into more these days. So they will go and invest in emerging markets, although we first heard that people were going to go into emerging markets back in 99, or into emerging managers. And then you ask people, what's an emerging manager? If you ask a pension fund, it's a guy who's only got 10 years experience and $12 billion. For us, it's guy's got 20 million bucks, 10 of it's his own. And, he's putting everything into it. Now those guys pay off usually because they're pretty focused. But there are people that are now looking at it. I've got this portfolio, not ours guys, because they don't have a plan. He's got to give them a plan. But guys that have a plan have a bucket. It might be a 10% bucket, and that's for other. The 90%, they're already rich, and they've got a plan and they're doing well. But that 10%, which depending on how rich you are, could be $10 or $10 billion, is for risk. It's for growth. It's for their fun. Going into managers that are starting up, and some for the share in the fees, some for the lower fees of a founders class, and some just because they're interested in what the people are doing. So there is opportunity. It's just taking that. And I can tell you that when I'm selling a new manager, there's only 2 people that are in a hurry in the room: me and the manager. Nobody else really cares about our time schedule. They'll if they want to do it, they'll do it, and they'll do it when they want to do it. So that's what I would add. I would say I think that people are unsure, including me, about how all the digital assets work, whether it's a Bitcoin or whatever. But people are interested in depth and understanding more about it. We've been told and mandated by FINRA that we got to talk to them about if we're going to take somebody on. We got to talk to them about how we're going to do due diligence, how we're going to make sure that what we're bringing out to market is legit. And I got to get it pre-approved now, which is very strange.
Or
Never
a
been that way
digital
before.
or digital assets. You got to get it pre-approved. You have to get your due diligence pre-approved. They have to look at that.
They always look at our due diligence on everything. When they come and
You do
check
your
things
audit.
out and do our audits and just drop by.
Mhm.
But in digital, there's a lot of concern because they don't know where it goes or how it was made, or there isn't really a Bitcoin. We can't really pick it up and touch it. So I think that's a good idea for one of those Christmas gag gifts. Is we should just all get together and make a whole bunch of Bitcoins and sell them at every little store in America.
It'll cost you 30,000 online, but you can get it here now
$10.
for $5.
So
No, but
anybody who's in, see me after that.
There's actually a question for you, Chip, which is, what are returns people are searching for in emerging market investing or emerging manager investing?
well,
Is
emerging
there
market
is
and
there-
emerging managers.
Is
are
there,
two
is, there,
different
is, there,
things.
is there a difference in the way people approach
They expect more.
domestic versus emerging markets?
Well, right now, I mean, I've got a China fund and I'm not finding a lot of people knocking on my door. Although China isn't really considered that much of an emerging market right now, but emerging, either of those asset classes, whether it's an emerging manager, which covers a lot of asset classes, or emerging market, which covers, again, a lot of asset classes, there's a higher expectation because they are perceived as higher risk. Okay. So what do they expect? I would have told you a couple of years ago, they're looking for 20s. But now, if you can get teens out of either of those, people are happy. And people's expectations have dropped from 12 to 7. Yeah. Do they want more? Of course. Will they be satisfied with 7 in this environment? Probably. But in the alternative buckets that I deal in, I gotta double digits. Annualized, where people are like, why am I gonna pay anybody, whatever it is, 1.5, 20, or whatever the hurdle is, whatever. I need doubles because it's all taxed, right? And most of the people that are putting money out right now are in a high tax rate.
Interesting. Yeah.
Yeah. And the other thing we're finding is people like well thought out tax strategies coming from their managers, being smart about taxes. Depending on your mix, if you're $10 billion and $9 billion of its pension fund, you don't care. But if you're $1 billion and 800 million of it is coming from high net worths and family offices, they care about taxes, and your managers should care about it.
Can I just add one thing about, the emerging manager side?
Please.
What I found with a couple of family offices that I've dealt with and a manager, I'd say a startup manager, they're looking for what the manager is doing is attractive to them, but also getting a piece of the business early. The operating business has been an interest for a couple of people that I've dealt with.
I hate those people because there's no room for me, but
I think there's a
you know, I
question
get so
from
much.
Yes.
the audience. Blake, are you there?
Yeah, I saw him a minute ago. Hey, Blake, how you doing?
Hey, guys. Question, where do you see risk in the various strategies that you guys are looking at? And also, or secondly, where do you see crowded trades that are popular, everybody's bunched in, and there may be some inherent risk if everybody tries to get to the door at the same time?
John, you want to field that?
Sure.
You got
He
it.
throws a
You worked-
softball out all the time,
you
doesn't
worked
he?
it
By the way, hi, John. The last time I saw John was playing golf, I think.
Yeah, so crowded trades, I would just say that I think with regards to the equity markets, less so maybe in the hedge fund space, only those groups that are the large multi-strat groups that are, when we get a market downturn, they're going to have to decrease leverage, and the managers on their platform are going to have to dump, right? And so if you're in the managers who are low net market neutral but are playing the mid cap space, if they can demonstrate to you that there is minimal overlap, there will be overlap, but minimal overlap, I think that those are managers you'd like, barring the fact that they have good returns, all that's good, but they have minimal overlap and they can track that to those large, Millennium Citadel-like groups so that they don't get taken out when those groups don't. And so obviously that's a correlation thing as well, right? So I think that that's probably one of the bigger issues that we're seeing out there at this point in time from the groups that we cover. And obviously investors are looking at it, and they want to track that, and they want the managers to track it.
Chip, anything that, or are you?
You know, we don't really get into the managers we represent. We, you know, view their portfolio for only one real reason, which is if they tell you they're in long short equity and you get to look at their portfolio once a quarter and they've got half their money in gold, you know that they're not doing what they said they were going to do. So for me, it's more, you know, you tell us what you do, you got to do what you say you're doing. I don't know about crowded trades or anything like that. You know, you need to ask your managers, you know, what are your top 10 positions? And if you find right across the board, all your managers' top 10 positions are the same, which is highly unlikely, but if it is, then you know you got a crowded trade problem.
And that was something that LPs have been trying to do for a long time. It's not just managed food. It's to get down to that tier where they can see what those underlying investments are and how heavily weighted they are into those different. And I guess, Howard, that's sort of like your strength. You do a lot with back office systems, things of that nature. Are you seeing improvements for them, particularly around the hedge fund field? Private equity, it's a little bit easier. They know who the companies are, but hedge funds have always been a little black box that you can't see.
Yeah, I mean, there are some that you can see through and some you can't. And I think people are quite a bit more interested in transparency. They want to see what's there. And I think people have been burned with, you know, the black box. I can't show you this. I can't tell you my theory. I can't tell you any of this, you know, and like, you know, it goes back, you know, for people in this room, you know, people have heard of Madoff, you know, there's a generation that never heard of him. I'm like, you know, you got to understand the history.
Yeah, but Madoff told you his strategy.
Yes, but he
Madoff
wouldn't.
didn't hide anything about his strategy.
He told you
What
his
was so-
strat.
What was,
That's
that
right,
was
he
what was
told-
so bizarre.
Right, he told you his strategy, but he wouldn't give you the backup to prove it.
Well, the issue was that anybody of any knowledge of constraint theory would know there wasn't enough capacity in the strategy to generate the returns that happened.
And no manager should have custody and management.
Actually, I'm gonna go one step further, because we did the work and I know a lot of the books on Madoff, and you could get the statements from the separately managed accounts. And when you went through them, you found that almost all the buys were at the high of the day. And almost all the buys were at the low of the day, and almost all the sells were at the low of at the high of the day.
Yeah, but that's if they were actually, you know. in
Well,
the
they
range,
were,
right?
they were now know they were manufactured statements,
Right.
but even not knowing they were manufactured statements,
But
just
some of them
seeing
weren't
them.
even in the range of the day. I'm sorry, but you know.
Yeah, so rather than have a melee here, we'll wait to
I
But,
just-
can we talk a little bit about
We're
private
keeping an eye out.
equity and the differences in how managers select private equity and what they're looking for in private equity, how, you know, how people go about selecting private equity investments? This seems to have grown to be a much bigger share of the family office space these days. And
Sure, and they like private equity because they've all gained their wealth, or a lot of them gained their wealth from running businesses and growing them. And it's very near and dear to their hearts, and they want to repeat that over and over again. So I'll let John start off, and then to my left here, we'll get Chip back
Yeah,
in there.
and actually, I'm gonna go back to what Blake was asking about. Sorry to revert here, but what we've been hearing from a lot of the institutional investor base, and they continue to re-up, right? So it's not as if they're cutting their allocation, but they feel that their the valuations of their PE and VC portfolios are at the very least fully valued, and I use that in a very loose term. So with regards to, you know, I don't know if it's necessarily a contagion, but certainly from a value base, they don't view that there's a ton of value out there at this point in time. So, but, you know, that's what we're seeing with regards to, you know, I think the analysis, you know, they're looking for really the same things, right? Where and how is that manager creating that differentiated alpha? What are they going to do? How do they differentiate themselves? And then So once they've been able to do that, then why are they of value for the portfolio or for a portfolio? Most capital is all allocated. So most of the money's coming from, I'm redeeming from somebody and now I'm going to put it back out. It's not like I'm walking up and I have a complete cash bucket and I can go out to 10 or 20 managers.
Let me
Yeah.
just take this. So private equity firm gets their money and their usual spend rate is like 50% the first year of money they get in.
Yep.
They commit a capital they try to spend. And I don't know if that's your experience with Graham Capital or not, but if you want to toss in and share your insights, feel free. So I think as they're stepping out, you heard the Belkin report a little bit earlier today, and he's saying the next 12 months, and we all know private equity is a laggard, but let's just say that gets extended to 18 months of the down market. Private equity trails behind that could easily be 20, 25 months. So you're talking 2 years, that could be 60% of the capital that's been allocated to that fund is now allocated at peak values. And,
Right,
it
but
could-
I guess you're thinking about it in a longer term format, right?
well,
So-
it's a
so-
7-year play, right?
Yeah, well, 10,
10,
10,
12,
10, could be 12.
15.
Or
They're-
15,
they're not
20.
private
They're not
equity.
paid. They're not paid.
They don't do
I
private
know the
equity.
fee. I'm sorry, I
Right.
apologize.
But so the time frame is longer, so you're not necessarily gonna try and time how much capital you're putting out, right? So you're gonna pick the managers you wanna be with, and you feel that the assets that they're allocating to are value added to the portfolio. They have a particular edge that they can bring to the table, and you're gonna gain X amount of alpha, say over the next player. And again, everybody's in the first quartile, so it's always difficult to make that differentiation, but it's then a matter of managing your capital to be able to allocate and re-up, and occasionally bring in new, right? So, and that's the process that you're gonna go through.
Fair enough. Chip, you want to piggyback on that or?
And are people looking for like, co-investment or?
Oh, yeah, co-investment's huge. That's big out there. I would say probably at a minimum, a quarter or more of the PE investors are looking for a co-invest opportunity. And that's with PE or VC. So I'm using that broadly. Could be with real estate. It could be with any unique credit opportunities. But the vast majority of groups, if they have the bandwidth to do it, they're looking for co-invest opportunities, right? Because they get a sponsor, the asset's already in the portfolio, and they get to pay a cheaper rate for that investment. So it's a win for them.
And secondaries?
I'm not seeing tons of
Not
secondaries.
Interesting.
On private equity, back to Mark's question. First of all, the big advantage that private equity managers have right now is they don't mark to market. And whenever I sell something that has even a 3-year lock in a kind of a crossover hedge fund portfolio, and I say, our annualized return is 7.9%. Oh, anytime I lock up my money, I get 20%. Well, we'll see about that. I don't know that they're all going to, be returning 20, 30% in the current funds or the funds that have been raised in the last 3 or 4 years. So I think there's going to be a big change, and people are going to be more disappointed than they have been in the last 15 years with the current funds or ones that have been invested in the last 3 years. Because at some point, there's no buyers, right? If you sold it your $100 million fund, sold to a $500 million fund because the public markets are hard, and you sold to the $1 billion, and then they're going to sell to the $20 billion fund. Where does it go from there? It's either got to be an operational company that's stuck in a 20 billion, 30, 40, $50 billion fund, or it's dead. So I think there's going to be a lot of change in venture capital and private equity over the next 15 years. And hopefully I'm not in the business.
Now, Marty asked about secondaries, but I'll ask about recapitalization funds, things of that nature, people that try to buy businesses in distress, special situations, those sorts of things. Are you hearing much
Special
interest in that?
There's always distressed companies out there, no matter what, people want to invest in distressed or not. There's always distressed companies. There's always families that are squabbling that need to get, liquid. And I think that it's a very interesting area. And every family office seems to think that they want to do direct investment because they were successful at, chemicals. Well, why won't I be successful at everything else I do? Not without you helping. I think that, it's an interesting market. I think a lot of people are going to lose some money and get burned in that direction. But we'll see.
All right, I think Marty's got us wrapping up now. So what I'm going to ask everybody to do is just to give their, the one point or theme of the day that you think people should walk out of the room with. So, John, we're going to start with you.
You always get to go first.
Yeah, I know. was
I
gonna
started
defer
with
to
you this
Chip.
morning.
I was going to defer to you, Chip. What's the theme? I think that there are numerous investment opportunities out there that people should be taking advantage of. I think also that, especially if Chip's engaged with a really interesting strategy, I think people need to look a little bit more far afield for their opportunity sets. I think that just because they may not have experience in there, doesn't mean they shouldn't go get educated and get engaged in those opportunity sets, because that's where they're really going to find true alpha. It's more difficult if you're looking in the venture equity space. Way more difficult to find that. You're going to have to go through, I don't even know how many managers, right? Maybe you go through 200 and you actually find, 5 out of there that meet the requirement for you to allocate to. And maybe it's even less than that. So, so what I would say is, go out, dig around, use the resources that are available to you. Someone like myself, someone like Chip or Howard, people are out there and you can use them as tools for you to help you in the search.
Howard?
From the manager selection perspective, it's to me, it's always about consistent, repeatable process, history of success, and look behind the curtain. Look at the numbers, look how they, made the numbers, not, actually put them together, but like, what kind of asset base did they have? How did they, cobble all this together? And behind the curtain, can they function operationally? Because if they can't function operationally, it's going to eventually take down the investment side of things.
And you help them do that, right?
That's what I do. That's one of the things I
Just
do.
want to
Yes.
make sure everybody
Yes.
knows that.
Thank you. I need a sales guy.
Chip?
I'm not
That's
gonna
what I
be-
do.
I'm
What
not
can
gonna
I
be
say?
sales I think the thing that I'd like you to take away is don't be afraid of emerging managers. Don't necessarily change the way you do due diligence or what's worked for you in the past. But, give them a look. I'd say it's a proven fact, but I can't prove it to you right now. But emerging managers, smaller managers usually perform better.
Yes,
And,
that's true.
and, if you're looking for alpha to add to what you're getting in your current portfolio, take that portion of risk capital that everybody's got in the back of their mind and look at some of these people. There are some very good, very fascinating ones, but just understand you're not going to be able to, if you're really rich, you're not going to be able to load them up because the funds are going to be small for the most part. I've had a couple of guys that I took on 100 million that are $6 billion now. And they've been able to manage it, but not everybody can do that. And a lot of guys that are at 25, 30 million, they may cap out depending on what their strategy, especially at small cap, at 100. So give them a look.
I think, Kaufman Foundation did a study a while back and looked at newer managers, found out they outperformed the market, particularly fund 1, 2, and 3 were strong performers. So with that, my only advice or the last thing I tell everybody is if you're out in the market, these guys are great resources for you. Tap into them. So thank you for your time. Thank you for your comments and enjoy doing this again, Marty. Thank you.
Good job, guys.